Just had an itchy ankle under that sock. What? Well, if history tells us anything, it's that Sydney's property market share of peaks and troughs, with the latest downturn a sign that our nation's biggest capital city isn't necessarily as safe as houses. So what can Sydney's housing market history tell us about the state of real estate across the country? Propertyology's head of research, Simon Presley, is with me now in studio. There's always ups and downs, right? Talk us through the last 30 years in Sydney's market.
Oh, look, always ups and downs, Brooke, but I think when you're in the moment of a downturn, it just seems like all you've had is a downturn, and when you're in a boom, it feels like it booms every year, but of course it doesn't. Sydney, our biggest city, 30 years ago, median house price was $155,000. Today, it's about $900,000, so that's a heck of a lot of growth that we've seen over the last 3 decades. Sydney's had 2.5 booms over that period of time. Australia's biggest property boom was 1999 to 2004. Sydney prices doubled in that period of time. I say half a boom. 2010, the stimulus package. Sydney had a good year there, as most of Australia did. But other than that, the only other boom that Sydney is, cities for that matter, is the one that's just gone. So they don't come around very often. That's something well worth keeping in mind. And
when you're in the middle of the downturn, they feel awful, right? Let's compare downturns.
They do feel awful. Look, Sydney's biggest downturn was back in the late 80s. It was a stock market crash that actually caused that. The downturn that we're in now is the next biggest downturn that Sydney's had. A typical median price house in Sydney today is worth, somewhere close to what it was in early 2016, so 3 years ago. So that's a significant decline. It's getting close to $200,000 off Sydney's median house price over that period of time.
Yeah, and you've worked out if we drop another 10% in the 2019 calendar year, we're back to about early 2015 prices.
Exactly.
Right?
Now, from 2016 to now, Brooke, there's been about 250,000 houses and apartments bought just in Sydney. That's comparable to, say, all of Canberra and all of Hobart over that 3-year period. A typical house is worth the same, or in most cases, they pay for it. So it is quite a big downturn.
Yeah, so it's significant. It was interesting, there was an RBA paper that came out today, and the view of the Reserve Bank inside this paper anyway is that it's basically interest rates that drive house prices. Not really supply and demand, not population and other stuff like that. It's really interest rates, that's the big thing.
If only it was that simple. Think of property markets as one big jigsaw puzzle, and interest rates are part of the affordability side of that. But of course, properties are expensive, and in most cases there's a mortgage attached to that. Interest rates have a bigger impact on Sydney's house prices than anywhere else in Australia because, of course, they've got the biggest mortgages.
So what about population growth? Population
growth is one factor, one of about 20 factors all up, but it gets a lot more airplay than what people think.
Yeah.
Population in Sydney, in 2000, we've got a chart here, we'll just go through. Over where you are over there, Brooke, the last...
This is 2002 here, 2018 up your end.
That's right. And the first 3 columns you've got there, Sydney's population grew by about 20 to 30,000, but that was actually Sydney's ever seen. Up here, the boom that Sydney's just come out of has had the 2 biggest calendar years in Sydney's history for population growth, but yet here we are in its second worst property downturn. Supply is a big part of this, and that's these blue columns here. You can see an enormous amount of supply. These are building approval volumes from sort of 2013 through to 2018. Things that have been approved here will, of course, be built over here. So we've actually approved a lot more dwellings in Sydney than what its population requires. What gets missed with population is everyone assumes that one extra person, we need one extra home. Population is broken down into components. Sydney's 100,000 population increase, 65,000 of those were babies. Babies don't buy houses, they buy cots. 30,000 were deaths. That actually releases supply to a property market. 18,000 people left Sydney through internal in another part of the country. The biggest component of Sydney's population growth is overseas migration, which is about 84,000 of its 101,000. And a very high portion of those don't buy, they rent. Because they've got visa restrictions, they can't get finance, they want to get settled in a home and a job and those sort of things. So the biggest impact on property prices is not population growth at all, it's buyer behaviour. It's the people who are already living in a community, whether they can afford something and whether they're in the mood to buy something. And that's largely economic related.
OK. Growth cycles. Let's talk about growth cycles. We've got the boom behind us. We just saw your last graphic. We've got the downturn that we're in, which, as you said, is pretty much the second worst that we've had in recent decades. So what do we learn about growth cycles here from this?
Yeah, well, as we're talking about, booms don't come around very often, you know, once every 15 years or so. This is looking at the last 30 years of 5 capital cities here. Let's look at the red line. Over where you are there, Brooke, right up to here. There's a long period of time where Brisbane's house prices increased quite significantly. But if we have a look, B1 through to B2, that's a very long period of time, 7 or 8 years where prices have not moved. Exactly the same horizontally. Sydney, S1 where you are over there, Brooke.
Black.
Yep. To here, S2.
Yep.
2004 right through to 2012, that line has barely moved. Right, a very long period of time. We can see the same, there's a period there for Melbourne, for Hobart as well. Typical property in Perth today is actually worth a little bit less than 10 years ago.
Wow, OK.
So booms don't come around very often. It's better to buy...
You can see S2 going right up to your end with the... that's huge. S2 to right... Yeah, the other
Absolutely.
end.
So the learnings for people about property markets, it's better to be a bit early into a market than it is to buy in the middle of a growth cycle. Someone who bought in, say, Sydney or Melbourne in 2016-17, we're actually a little bit behind the 8 ball now, and it might be several years before they see some growth.
OK, so key takeaway, risk too early, don't be a year or two late.
If you're a year or two early, you're going to get 100% of that cycle when it kicks in.
Sure. All right. Is bigger better? In the
absolutely not. Absolutely not. Sydney is our biggest city. We all know that. Melbourne is our second biggest city. We know that over the course of time, every single location, including, believe it or not, the back of Burke, all have significant price growth.
The actual back of Burke.
Actual back of Burke. But it happens at different years, different amounts. Over the course of time, what we've got here on the left-hand side of that red line there is our 8 capital cities.
Yeah, so you've got Canberra, Sydney, you can't see it necessarily because of the writer, but Canberra, Sydney, Darwin, Brisbane, Adelaide, Hobart, Melbourne, Perth, just next to that orange line.
Now, the green columns there show the average annual rate of capital growth over the last 20 years. So you can see they've all grown by a phenomenal amount there. Darwin, the worst there, a bit over 4%, but most of them are sort of around that 7 or 8%. They haven't all grown by the same amount each time. Over here, we've got 8 other non-capital city locations, places like Geelong, places like Byron, Maitland. They've all had similar rates of growth. In fact, some of those non-capital city locations have actually had a better average annual capital growth rate than many of our capital cities. So all markets grow, they just grow by different amounts in different years. The blue columns here at the top there show the rental yields. Very expensive properties have low rental yields. Sydney, of course, has a very low rental yield, as does Melbourne.
Just that one there, Sydney there. Yep.
The second one.
Yep, the second one.
But as you can see, the non-capital city ones, the blue columns are much higher. So for an investor, the actual impact on your household budget is much, much lower than really expensive markets.
Yeah, and again, the second bar on your side is Launceston, which has got a nice chunky blue line there.
And you measure a total return, you add the two together, and these columns generally are higher than our capital cities.
Right, so big is not better. Cash flow. I mean, especially when you're talking about property downturns, this is where you really got to focus your energy.
Absolutely. Cash flow, it's important to respect the cash flow at the time of purchasing. When you're entering a market and things are really strong and people are excited, they sort of think, oh, I can afford this, no problems. When there's a downturn now, this is looking at some city councils across Greater Sydney and what it costs to hold a typical property with a 10% deposit. We're talking sort of in between $30,000 from there upwards to $50,000, $60,000 for a basic house.
Yeah, Middle Ring Sydney. People know Sydney. Coogee, Bondi, I might not be surprised at that.
Even here, Bondi's apartment. It's going to cost you $20,000 to hold a basic apartment in Bondi.
So the house versus the apartment down there. But...
Absolutely. Parramatta, Middle Ring Sydney. Right, $30,000 to hold that property. That's the difference between rental income and expenses. Middle Ring Brisbane, over here, Middle Ring Brisbane, that same property that you'd buy in Parramatta would cost $11,000 to hold compared to $30,000 in Parramatta. Hobart, Australia's best performed capital city over the last 3 years, will cost only $1,000 per year to hold. And as we know, you get just as much price growth if you get your timing right in other markets. Yeah,
and I think if we had more time, that'd be worth probably spending a lot more time on just to kind of that cash flow issue of the way. And you've got one more graph, which I guess explains it in some ways, but I mean that's so vastly different from a cash flow perspective. And as you say, if the asset value is going down, if you can kind of manage the cash flow, you actually are right in a lot of ways,
and things can change, whether it's a market that changes quickly, like we've seen Sydney and Melbourne do, or whether it's the personal household budget. Things can change quickly as well. So if you respect the cash flow at the time of investment, it keeps you in control. When a market swings, you can determine whether you're going to ride that market out or whether you will sell.
Talk us through this one.
Last chart here is talking
Poor old
about...
Tasmania doesn't exist on this map. Sorry, Tasmania. That's a long-running joke, though,
strategy.
right? Yeah, OK, let's go strategy.
If you're a property investor, don't think, or a property buyer, think like an investor. Imagine if you were a share investor and you had $200,000 that you released from, say, equity in their family home. Would you put all that on Woolworths Brook, or would you put all that on a Commonwealth Bank? I'd suggest you break that into a few different stocks. A property investor, unfortunately, doesn't tend to do that. They tend to think, where do I live? I need to buy in this city. Now, if you live in Sydney, you would have bought that middle ring house in Parramatta, paid $1 million, $200,000.
Yeah, you would have thought, wow, we got 200 grand. That mean I got something worth $1 million.
Yep, and you got something basic.
800,000, right? Yep.
Now, that basic house in Middle Ring, Sydney, would cost you $20,000 to hold with that $200,000 deposit. Each and every year, I've got to find that $20,000. What I do, and what Propertyology clients help people do, is break that $200,000 up into 3 comparable properties where a combined value is still $1 million, $400,000, $350,000, $250,000. The cash flow is much better. So these 3 properties combined actually put about $3,000 or $4,000 into the pocket. That one Sydney property takes $20,000 out. Same combined asset value. Buying these properties in different states and picking towns and cities with completely different economic drivers is a balanced portfolio, very similar to what a share investor would do.
So being cash flow positive versus got to scramble together $20,000 every year. So big difference, same amount of money.
Cash flow is a benefit, but diversification of location. Sure. Right? If there's a downturn in that one big market, your whole portfolio suffers. If there's a downturn in one of the 3, the odds are the other 2 are going OK.
Simon, obviously people can see we had a slight formatting issue with that wall, but people absolutely get the gist. You've explained it well. Thank you, Simon from Propertyology.
My
Appreciate
pleasure.
your time.